Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Ben Vega from Umpqua Bank. Ben and I dive into a lot of topics, starting with an interesting project he had, recruiting commercial bank clients into the wealth management organization. I thought it interesting how you break down the barriers and build a program across silos in the organization. We talked about specifically a lot of the human digital, how those two things play together, what Umpqua is doing in that space, which I thought was really interesting. Their big bank attack program during PPP, which is also, I think, a fascinating conversation at the very end. What they mean by scored lending and what the future of scoring and maybe alternative data looks like, where that can be valuable. I think it's a great conversation and anyone can learn a lot from it. So please enjoy this conversation with Ben Vega. Ben, thanks for making the time and joining the podcast today. I really appreciate it.
Absolutely. Happy to be here.
Before we get into the content, there's a bunch of interesting stuff to talk about, but I always love to start with this question for my guests. How did you wind up in the banking space? It's not usually the childhood dream of most of the people I talk to. So I'm curious what path led you to where you're at today?
Absolutely. I think this is a popular question amongst most banking professionals as well. I started off probably a more traditional route. I was going to college, George Mason University, Northern Virginia, and the bank down the street offers college tuition, a reimbursement program. So that was Chevy Chase Bank. I was a teller there, and they were helping pay my way through college after I had graduated. I had a 4-year degree and also had 4 years experience, but also got a little bit more exposure to just what all, the different avenues that you could go through in a banking career. And I decided to stick with it. Moved over to Umpqua Bank in the Pacific Northwest. Started off in our branches. We called them stores at the time. Was there for a year. Then I moved into our private bank for wealth management. And that was a pretty interesting journey. You get a lot of exposure in the wealth management piece because a lot of your customers are borderlining on the consumer side, business side, commercial side. So having that for 5 years, I really did get a lot of exposure to the different products and services that we offer. Through some different types of synergies that we did, I went into our frontline strategy group. But prior to that, actually, we'll probably circle back on this, the topic of the conversation. When I was in our wealth management group, we started a program where we were partnering with our commercial bank because we're trying to identify customers that were within our commercial, the business owners that would be a good fit for wealth management. So they had commercial loans with us, but they didn't have any type of personal relationship. So I started down this initiative where we were going to get the commercial bankers to introduce clients to our wealth management, get that wealth management offering to them, utilizing some of the information that we had collected through the underwriting of their commercial loan. And this was ended up being very successful. And eventually, as we had some other groups look into how the organization was operating, I was then moved under what we called our frontline strategy group. So frontline strategy was helping build the strategy with our core banking lines of business. This is retail bank, home lending, commercial, SBA, et cetera. Basically the profit centers that we have, the different avenues that we have within the bank itself. As we went through another merger, I took a kind of a adjunct kind of dog leg in my career, and I went over to our ALM side, our asset liability management, working in our treasury group for our interest rate sensitivity analysis. Did this for about 2.5 years, 3 years. And this is where we're putting out the regulatory reports on how a bank's net interest income gets impacted through different rate scenarios. Basically,
seems like a pretty important topic.
Right.
This went from kind of not sexy to sexy in the last 2 months.
Right. It was funny you say that because I was recruited into that group. And I thought this was good. A good way to start rounding out my banking career. I had always been focused more on the production side, hadn't yet looked at the balance sheet, haven't yet looked at banking from the balance sheet finance side. So this was really good experience. When I was first moved over there, interest rates were flat for quite a while. And then I started going over them. This is when the rate hikes really started and things got a lot more interesting, especially because of the reporting that we were putting out. And really what happens is we run 16 different scenarios. So we'll start with our base scenario, which is just the current economic environment. What's your net interest income going to look like in 1 year? without any movement to rates. And then we'll look at it. What happens if rates go upwards 100 basis points, 200, 300, 400 in a ramp scenario, so slowly increasing. And then also, again, in a shock scenario, then on the inverse of that, what happens when they go downwards, 1 to 4%. And then diving into the analysis of that was actually really fascinating as well, too. So you're looking at most of our loan portfolios, what has changed month over month? How is the sensitivity, how has our net interest income increased or decreased from the prior month based on some of these scenarios? And you would see, what are we doing on our lending side, our cash side? How is our cash looking? So
$54,000 question, but were you guys looking at the asset valuation for long duration assets on the book?
So we had them mark to market already. So that was one thing that was helpful for us. So we had run the book that way. And what we did see, though, were mortgages, right? So we were having, in higher rate environments, generally what happens is prepayments start to slow. So people aren't going to be paying off their loan as quickly, which in the inverse of that, we're getting less cash back to then reinvest at the higher rate. So that was kind of one of the impacts that we were looking at when you look at mortgage portfolios or the different portfolios that we were invested in. So mortgage-backed securities. So you would see kind of slower durations on these types of security portfolios that we were invested in. And that, for me, I had never really looked at that part of the balance sheet on our investment side. I was always more focused when we, for core banking lines of business, to look at your deposits, your loans, and, getting these different types of investment portfolios that we put cash into. That was really interesting. But we're very sound in how we do that. So luckily, we had already been marked to market. Our book was pretty fair in that aspect of it. And I'm assuming you're getting into what happened in the last 4 weeks with SVB.
You bring up interest rate risk.
Right. Right. I know. And so from there, one of the executives that we had in the frontline strategy group, they're saying, hey, we want a product manager for our scored lending channel. And thought it'd be a great fit. So I moved into that. So that's what brought me into our scored lending product manager position in the role that I'm currently into now. And so quite an interesting career, actually. It all started with helping, an extra $5,000 a year to pay to my tuition. And now I found something that I really loved and been fortunate enough to be able to build on my experiences throughout my banking career to get to the role that I'm at now. And that's, some people maybe aren't as fortunate to be able to do that, but luckily within the organization they really kind of promote that, and they've done a good job retaining employees and training them up. So
that's fantastic.
Very thankful.
I want to get to scored lending, but I want to first go back to this really interesting project you talked about where partnering with the commercial bank to drive wealth management clients. And I want to ask a question in two fronts.
Sure.
This feels like the kind of thing that is obvious. I mean, we have a bunch of people who own small businesses that are doing well. We'd like to have their personal banking as well as their commercial banking. And yet I find that often either the organizational silos end up creating friction where this is the commercial bank, this is the retail. We don't communicate, or you have data silos that end up making it very hard to actually access the information.
Right.
So I'm curious what challenges you faced in trying to do that and how you overcame them. Because it to me feels like one of the things where you go, well, every bank should of course be doing this. And I think often they're not, and there are hurdles in the way. So I'm curious about your experience in those fronts, getting the organization on board with cross-pollinating across two very different set parts of the organization. And any kind of data or technology issues you had trying to often you can't get data about the commercial customers into your personal, your wealth management systems because they're just totally different, speak different languages kind of thing.
So I'll kind of go back to the genesis of this product, right? Your project that we have, and exactly that light bulb moment, right? Where this seems like a no-brainer. Here we have commercial loans. The borrowers or guarantors of these loans are more than likely qualified for some type of wealth management group. Just in the nature of that. So we're collecting, this information to underwrite the commercial loan. Oftentimes there's guarantees. So there's some type of personal financial statement that's coming over with these guarantors that we can review and, take a look at and say, hey, this person has, this amount of assets. And we think that, we would be a great benefit over here in our wealth management division. And it wasn't necessarily so much, or maybe it was just as much as the fact that, yes, we want to have a full relationship as much of a fact as that we're kind of branded as a business bank of choice, but at the same time, we want to know, hey, we offer these services too. And oftentimes customers, they really enjoy the service that they're getting from their commercial partners. And so we try to build off of that and say, hey, that service still matches on our consumer side, whether it be the wealth or side over here. And oftentimes they just don't know about it. So that was the idea. And now executing that idea, you're right, it wasn't as easy as I thought it was going to be. And there's a couple of different reasons why. One, so even with our culture, we have a very strong service culture. So that's also another reason why I thought, hey, this is going to work great. I mean, who's not going to want to refer their customer over to an internal department? And it turns out that it is a little trickier than that. And a lot of it has to do, one, there is a human element to it where we had to be very proactive, or I say myself, I had to be very proactive in identifying these customers first. And so going into what you're saying with the data issue, there isn't some gigantic database where I can just kind of run a query or filter on, hey, give me the individual borrowers that have asset sizes of this, but preferably, in an investments or cash, or, let's exclude their primary residence, et cetera. So one, it ended up being, okay, let's start identifying the types of commercial loans, the size, industry, maybe location. Like, do we have a wealth management office in proximity to where this borrower lives? From there, very manual to review the personal financial statement and any other types of liquidity statements that we got from these borrowers. And then from there, let's call on the relationship manager, kind of give them a prospect sheet, say, very socializing this as one of the things was actually deposit gathering, saying, hey, we offer, and this is what we actually found. This was really the ticket that helped them get the leg in the door with wealth management, was that these borrowers usually did have some type of relationship with us on the consumer side, but they weren't in the best product for them, meaning that they were also in a product that is probably the easiest to open, quickest to open, to do the transaction. Maybe they were just using it as a checking account, but we did have other products, due to the assets that they had, would offer them, some type of like wire services, so like, hey, you would get free wire services, free cashier's checks, higher interest rates paid on deposits of this amount. Let's make sure you're in the right product. So that was a very low hanging fruit. Let's service the customer, make sure they're in the correct product. Because if they're not going to be in the correct product with us, a competitor is going to come down the way and say, hey, your bank's not doing that for you. Well, we do this for those types of balances. So that was kind of the very first conversation that we would have with these borrowers. Other ones would say we would like to introduce them, but and I don't want to go like too deep into the tea here, but there's incentives. We hadn't thought necessarily about incentive plans. So it would say, well, who's going to own this relationship? Who's going to actually own this customer once I start to introduce them over there? How do we build the team around this customer? And that was not so much a point of I'm not going to refer, but there was definitely some logistics at the point of the point of service of, are you going to, is this customer going to think that I'm their banker, or are they going to think that you're their banker? How are we going to manage this relationship together? How are we going to build this team around a customer together, and who's going to be the point of contact? And so those are certain things that we wanted to hash out first in order for that to happen. So what ended up being, it did end up being successful, but there were certain things where it wasn't just as easy as, hey, this is, here's a customer that we have, and we're just going to reach out to them, not include the relationship manager, start sending them information regardless. We wanted to be very thoughtful about how we approached it, very considerate of the relationship. And at the end of the day, we wanted to make sure we were building the team around them with the game plan. And so at this, and I think the topic that we're on, human digital, right? There's kind of these pros and cons. And when I think of human digital, because this was a very human approach that we were doing, very manual. I guess I'd say, if you want to compare human to digital to manual to automation, it was a very manual approach. There was a lot of eyes on what is going to happen. We were kind of thinking through different scenarios where, opposed to how would we scale something like this, right? Like, this works good. We're doing it one at a time. It's working out, but hey, I'm one person. I'm going through personal financial statements one at a time. I'm literally pulling images of loan applications, loan documents, and this isn't going to be something that we can scale to. And like many organizations, it was also a need or banking organizations, I should say, up until this point, we had primarily grown through merger and acquisition, merging with other smaller community banks. And so here you have this portfolio of customers that maybe do have one foot in the door, or they had come from a different organization that didn't offer the types of services that we currently offer. And so it was really a good time to take a look at these types of relationships and identify customers that we could potentially grow, right? Expand upon those relationships. We've grown through merger and acquisition. Now we really want to start growing organically. And as I was going through this, yes, right idea, but one, it's not scalable. And what we ended up doing, which was actually really one of the first things, our first of its kind for our organization, we partnered with a local company, and we started doing something called next best offer, or what we dub Umpqua Smart Leads. And what this had done was identify model customers, and we're doing this for our treasury management suite of products. It's kind of expanding a little bit more as well, but we were saying, here's a model customer. Model customer being, here's a customer that is satisfied with the relationship. Maybe I shouldn't use the word satisfied. That's a little too ambiguous. But, here's a customer that is using our products and is profitable, right? And we have their primary checking account. We can see through their checking different types of transactions that they're going on. Maybe payments, right? And oftentimes we're looking at payments. Here's a customer that's paying vendors X amount at this type of frequency over this time period. And this would be a good opportunity for commercial card, ACH services, positive pay, certain things like that. And so what Umpqua Smart Leads does is it does this automatically, right, in a digital way. So every single night, it's going to go through our data that's processed, and it's going to start submitting leads to bankers to follow up with customers saying, hey, did you know your customer has XYZ over here, or is processing, X amount of transactions during this time frame, and we have a product for that, right? That's actually going to benefit them, most oftentimes save them money, because the different way accounts are set up, the types of volumes that you have cost X amount if you're not using this service. So that's one thing that we're doing is called Umpqua Smart Leads from a digital standpoint, opposed to the human approach that I had. So it's kind of a juxtaposition there when it comes to what we were doing years ago with the commercial bank and wealth management to what we're doing now. And there's also been a lot larger of a cultural shift in regards to partnering. So in addition to this digital element that we're using with Umpqua Smart Leads, I think the pandemic, this was an event that really helped rallied our associates around seeing the value of partnering together, right? I think, there's a lot of talk that we have that, hey, we're individually, we're not as great as we are together, right? So as a team, building a team around a customer, we can service a lot better than we could, versus if they were just only being serviced by a loan in our commercial banking center. So what's happened with the pandemic was there was the Paycheck protection program. And what we ended up seeing, I think, at the end, by this had concluded, right, the Fed, there was a set amount of dollars that they were going to lend out. And, as a lender, you have your customers trying to keep their business open, trying to keep their employees paid, all fighting for the same pool of money in a short amount of time. And so we were getting applications not only for our customers, but for customers from other banks saying, hey, my bank can't help me. Can you guys help me get this application through so we can get funded? And of course, the answer was yes. Let's do the right thing for our community, because these are local, oftentimes small businesses in our community that they can't get a hold of someone, at maybe a larger institution down the street, but they could get a hold of us. And even though they didn't have any relationship with us prior to that, we were going to get this loan application through as fast as we could and as best as we could for this customer. And this was a time period where, everyone was submitting these applications to the SBA website 24 hours around the clock. We ended up doing $3 billion approximately in these loans, which for I think that was definitely the largest in Oregon for a community lender our size. But we were it was quite the effort that we had. But to take this to the next level, what we also looked at doing was then following up with those customers that didn't have a relationship with us, right? So, and we kind of internally, we dubbed this, I think, something along the big bank attack or something of the sort there.
I love that. You mentioned that before. I love the big bank attack.
Right. And the idea was like, hey, let's grow and expand these relationships. We had gone to bat for these customers. We got a foot in the door with the PPP loan. And we know that if we start putting some of the people that we have in front of them, they are really going to love us and they're going to move that over. So the same idea came from, now we start with one relationship, maybe be on the loan side. How do we expand this into a greater relationship? And we had our store associates, commercial bankers, other that, follow up with these businesses and start moving over the entire banking relationship. And this ended up being a very successful program for us as well, too, which also really highlighted what we can do together with all the services that we offer. And so that also helped, a lot of people's mindset shifted of that, hey, this, servicing the customer, doing what's best for the customer is also best for myself as an individual producer. My customer's happy. They have people that they can talk to that I know are going to provide the same level of service that I do anywhere they go. No matter who they call, they're going to get that level of service. So that really helped change that mindset when it came to, going back to your original question, how do you start overcoming these internal referral systems, right? I think there's one aspect of, yes, it does need to come top down. There is a top down communication that needs to be have. There's, an incentive plan. You need to make sure that bankers are incentivized too. But at the same time, touching in, there's also a digital piece of it where this is a very human, decision. Whereas what we did with Umpqua Smart Leads, we helped take that human decision out of it. And we just started using the data to help generating some of these leads as well too. So we're kind of approaching it from two aspects of it where, that is something that can get improved with a digital solution. Helping with these it's not necessarily AI, but it is predictive analytics where we're taking a model customer and seeing, hey, what other customers do we have within our portfolio that behave like this customer? Meaning, do they have a loan? What types of transactions are they doing? Hey, well, that actually is similar to the transactions this customer is doing, and this customer is enjoying using ACH positive pay. So let's offer that to them as well. So there's definitely some digital tools that can help with that.
How do you think about
internal
that
referral?
That line, not the line, but this kind of melding. I feel like there was a period of time, and there's still some that feel like the personal is replaced by the digital, and it's going to be all at the point of interaction, all a digital style interaction, no humans in the loop. And then we've got the very relationship heavy stuff. And I feel like consumers are doing both things, right? They still want to talk to people. They also want to self-serve in a digital interaction model in different times. How do you think about how and where you balance those two things, how they work together? Like, what is the strategy for combining the human and the digital? Where do you think about one being more valuable than the other? Or do they work together in certain scenarios? I'm just curious how you think about the way these two technologies or two interaction modes play together in the future.
Right. I think probably the best answer to that question I have is actually our GoTo mobile application. And so GoTo is what we've really dubbed for our human digital strategy. It is a mobile application where we're putting the banker in your pocket, quite literally. And what's happening is that within this application, we have store associates who are chatting with you. So if you need something, you can launch this GoTo application and you have your banker there. And it's kind of the blend where you see other types of chatbots, AI chatbots, banks investing in that. Well, we're saying, no, we want to keep it human. We want to give you the access that you're used to with a phone, getting serviced, but at the same time, we want to make sure that you're having a human interaction. And that was really what we had invested in. It's been going on probably 5-6 years, maybe a little bit longer than that. But within the last 4 years, GoTo, we dubbed it GoTo, and that's where we're starting to see a lot more users interact through this channel. And they do really enjoy it because, one, they can get their questions answered. They can take care of their day-to-day business, but they're also talking to a real-life person. And that, I think, is kind of where we wanted to make sure that was still happening. These human interactions were still occurring through a digital channel. So we're in the space, right? We're on your phone, we're in your pocket, but we're also utilizing our associates to have everyday conversations with our customers. So they're still getting that same experience that we would have in person.
I want to ask two questions
yeah.
following up to that, which is one, how do you think about the mode of interaction? I mean, you have like text-based digital interaction with the real human. You have audio-based digital interaction with the real human, the phone call, and you have video. Are you focused on one or the other? Are you seeing interest in different modes? I'm curious what mode people are enjoying or what you're using for that kind of human, digitally mediated human.
Right. So we're seeing a lot more of the interaction come through our chat-based platform. And what we're also seeing is less volume come through call centers, right? So instead of having to staff up call centers over the phone, we're seeing more people engaging through the chat interactions through Umpqua GoTo. And then from there, we have this whole, what we call our digital cost center, right? And so from there, associates are still able to identify opportunities if they come in. So if a customer is asking for a loan, we can get them over to the channel to get that application process. And this is a good intermediary because not having the ability to apply now or apply through a website at this point in time, but still having the ability to talk to someone about a loan and get that process started is a very, a huge advantage for us as an institution, opposed to here, fill out a form and someone will get back to you, in a day or two. Right. Whereas I might as well have just walked into a branch, or by that time, especially with all the fintech businesses are going in, it's like, hey, I can get my loan applied for and funded in 48 hours, online versus, what's going to take me to actually have to walk down the street. Oh, you're not open, or I had to make an appointment, or, whatever, that period of time, can really be a game changer for some of the, regional banks that we have. So being able to have that conversation with our customers right there in their pocket and get that process started one day sooner, right, is just, an advantage that we're definitely trying to capitalize on and get into that space.
Yeah, the ability to execute and deliver quickly is certainly something customers are demanding. I mean, not just expecting or wanting, but kind of demanding at this point. They're spoiled by Uber and Amazon Prime, I guess. That
absolutely, that's our big. It's our when we think of technology investments that we have, right? You can't do everything, but you can do some things right. You can do what's right, and one of the ways that we decide that what we're going to invest in is kind of the mantra for one day sooner. Is this going to help our customers board their loan one day sooner? Is the application process going to go one day sooner? How is this technology going to help get something done one day sooner? So that's really what we have internally.
It makes me think of the song "One Day More" when you say that over and over from Les Mis. You need a theme song for "One Day Sooner."
But that would probably fly.
I'm sorry, just I'm a musicals guy, so I got one day. Anyway, I can't sing.
I like it. Yeah.
You got to find a way to get the one day sooner as a mantra. But that's a great mantra. I love it. And it is, it is amazingly powerful when you can accelerate the timeline to value for your customer, how much that can improve your conversions, your pull through, your overall business and satisfaction with the customers that you have.
Absolutely.
One other question is, the chat-based interaction is interesting even more recent than the banking issues and interest rate risk hedging and management is this concept of generative AI and chatbots that can kind of behave in a human-like way. Is that something you've looked at all, or still I'm also, I went into ChatGPT and I said I've got an extra $1,000. How should I invest for my retirement?
Right.
It'll do a pretty good job breaking down Roth IRAs and IRAs and 401ks and in different investment options and where you should start and whatnot, and savings accounts and CDs. But have you thought about any ways to take the first round of questions that can be automated, or is that still
we're committed to the human interaction within that channel. One thing that, and this is what I've actually loved about Umpqua, is that we're not, I guess what we would say, hey, we're not a sales culture. That the purpose of this channel isn't to sell our customers something, right? It's to provide service. And we really believe that service first leads to more business. So we have a very service-based culture. It's actually really interesting. Back when Ray Davis started the bank, well, had taken over as the CEO, he dubbed all of our branches then, stores, right? And this store experience was really based off Nordstrom, and we would hire not bankers, but we would hire people who worked at Nordstrom, people who worked at Starbucks, people who delivered, service. And this was in our front of the house within our branches, or what we had then called stores. And so how did we, what we want to do is translate that experience into a digital experience. And some of the stories that come out of this, for the Umpqua GoTo, is being able to do follow-ups with your customers when they say, hey, I'm trying to finance a wedding. Okay, great. Not only will we do that, but, we send you the handwritten card. There's certain touches that we follow up with, help them, put them in touch with a florist that we might also bank as well, really expand on that network. And we think that empowering our associates to have that human interaction with our customers goes a lot further than to be able to kind of constantly offer, basically mining a conversation for sales opportunities. That's, we're kind of going the different direction. We're mining these conversations for service opportunities, which, hopefully then leads to good graces and getting more business and referring friends and kind of having this net promoter score in one way or another. But we want to just really be satisfied with the service that we're giving. So very, very kind of hard lined with, the AI isn't meant to do sales, right? Where you might have something like a different chatbots. I won't name industry names, but certain things that don't necessarily work. They're just trying to get you through a queue. They're trying to take volume out of the call centers. We're actually just trying to translate our in-store, our in-branch experience to a digital channel.
Excellent. And I want to. Kind of strange that we're getting to the end of our time, and I'm going to ask this question, but you said you're product manager for scored lending. How do you guys define scored lending? What is that? I mean, I feel like all lending should be scored on some level.
Right. Well, I think through our loan channels, right, we do a lot of larger commercial deals that need to go through custom underwriting. So scored lending, what we define as scored lending is within a parameter set, loan amount, collateral, risk that can go through a scoring model that can basically kick out a approval based on an amount of factors. And then from there, help expedite that funding. So typically right now we're doing 3 million and under for business, and all of our consumer lending is scored for the most part, unless there needs to be some type of custom underwriting. So it's really based on loan amount and risk for the most part of the different products that we have. And so this is pretty new. I wouldn't say newer for organizations, but a lot of organizations that are still out there on a regional bank level, they will do the custom underwriting. They'll go through, you'll apply for a loan, and it will go through underwriters, some type of credit underwriting center. They'll take a paper application, they'll go through your financials, and they'll do an approval that way, opposed to one day sooner, right, or something of a scored lending channel to be able to get that approval, get the documents processed, and move forward. And when it comes to human digital, even with our scored lending channel, right, we still have human interaction, where if we could kind of get down some of these manual reviews, whether they be for fraud or incomplete applications or certain things that don't quite fit a credit box, and we could identify and eliminate those human touches, we could start really getting one day sooner to funding for our customers too. So even within a scored channel, there is human interaction, and the onus as a product manager is to really help drive, a one day sooner approach on what are we doing, and, how can we get this done in a more streamlined fashion. And fraud check is a big piece of that too, right? Yeah,
for sure. One thing I did want to dig in on is the idea of, when you say scoring, I love it, but there's also this current debate about alternative scoring approaches, alternative data used in scoring. What's your take on the opportunities and risks associated with, going beyond the traditional, when I look at even most scoring mechanisms by banks, there's, for consumer loans, there's a handful of variables that's related maybe to equity in a house or an auto loan. And then it's like credit score, 10 or 15 things coming off the credit file. And it's a pretty straightforward set of pretty traditional metrics that are used to make those recommendations. And there's a whole, sets of data that are non-traditional that are being used by some lenders. So I'm curious how you think about, moving forward when you're in that automated scoring mechanism. All of a sudden the question becomes, what other kinds of data or broader
Absolutely.
data could we use to make better determinations?
Right.
Where are you guys at in that journey? What do you think the future looks like?
Yeah, absolutely. So there's, is this telling the whole story of the customer's ability to repay, right? Is this the best method, or are there some of the scoring models, some of the larger, FICO, Advantage, some of these models that are out of the box, are they really doing the best to mitigate risk, right? And it all comes down to the risk of the portfolio from a bank's eyes. And so right now, these traditional models, their advantage is that they have results recorded, right? There is results of, exactly, default rates, certain things like that have worked in the past. But that is starting to turn, right? These alternative credit models are starting to say, hey, not only are we seeing lower default rates, but we're being able to approve more borrowers within, that these models would have declined. One huge thing that I think that's kind of a really big focus for us too as an organization are these special purpose credit programs. So, we want to be making sure we're lending to communities that these traditional scoring models wouldn't necessarily approve, right? So how can we do that? How can we do more lending, investing in minorities, women-owned businesses, Black-owned businesses, certain things like that, where, hey, they weren't getting qualified through these traditional scoring models, but you know what? We're going to be using alternate scoring models that will help them with our special purpose credit programs, opposed to, just lowering the score for some of these loan applicants versus, keeping them versus like if they didn't meet these types of the boxes that we met. So for me, top of mind for alternate scoring models, I think there's a great advantage to be helping with the special purpose credit programs that are out there. And also, I think just the more that we're able to proof these models and their efficiencies, to mitigating default rates, the stronger it's going to be in the corner too. So
excellent. Well, I think that's most of the questions I have for you, Ben. I appreciate it. This has been a great conversation. I do have 3 questions I like to ask everybody at the end of the podcast. So
absolutely,
we can jump to those. Ready? First is, what's the best piece of career advice you've ever gotten?
Well, I'll just go through what my journey has brought me to is that, it always try to be building on your past experiences. So, be mindful of your career approach. I think that some people or some associates, easy to kind of just accept the fate that they're at within the organization. But if you're intentional about your career path and working with the manager to get you there, I think that's one of the steps that I would take is always trying to build upon your past experiences for your new role, and also look outside of your organization for not new opportunities, but to see what your organization is doing. Because I think oftentimes too, when you're in an organization, I've been with Umpqua Bank for 11 years. But if I wasn't curious, staying curious and looking at what other organizations are doing, what roles are they implementing, and bringing that back to our organization as well, I think that helps kind of diversify the ideas that you can bring to your organization as well.
Love it. Second question I got is, what's the best advice about the, retail consumer banking industry in general that you've gotten or give?
I would say if you're a consumer right now, looking around, I think you're in a really good place. I think with the fintech industry that's happening, you're getting options. And just like anything that they would say, like if you're going to shop for a mortgage, make sure you're shopping around for a mortgage. But same thing as a consumer, if you have a lot more options to you than you did previously. And there are companies who are fighting to provide that service. So, although it might be hard to switch your checking account from the institution you have now, it might be worth doing so if you haven't looked around in a while, because there are companies that are willing to kind of go above and beyond to kind of break down some of those barriers that they have from the banking industry, that could really provide exceptional service and, make sure that you are valuable as a consumer in this space. I will tell you that much right now.
All right. That's great. And the fast one is, what's one bold prediction for the future?
I would say that, one bold prediction for the future, that would really be for me. I think that we're starting to see, one thing that's a popular belief within this current industry right now is who your competitors are as a bank between your asset size. And I see this all the time where it's, hey, you're a $50 billion bank. Well, here's, let's compare you to other $50 billion banks or less because these are your competitors. And I think that there's a digital landscape that's happening right now where, we are competing with bigger banks. We are competing with fintechs, and we're not just within a asset class of who our competitors are. And so I think that the competition within the organizations of the products that you're offering, really needs to broaden that scope because it's not anymore of just who's in your footprint and who's in your asset size. I mean, it really is the ability through this digital channel to be able to shop around as a consumer. And if you're not capturing that and you're, if you're thinking that, you're kind of safe with who your competitors are and you're going to price similar to your competitors based off asset size, I think that that's going to be a detriment to your organization. Definitely.
Interesting. It's very true that you can think of your competitors from an equity investor point of view. Maybe your competitors are banks your size. That might be who wants to fund the company, where you'll be compared when you do your earnings call. But when a consumer on the internet trying to find which loan I want to take or which deposit product I want or where I want to invest my money, they couldn't tell you. I bet most consumers couldn't tell you the asset size of the bank they work with. It's just not a relevant consideration. Right. They're comparing against across a lot of different competitors.
Right. And, we're relying on third parties to help kind of provide some of that data. And they're always trying to bucket you in these competitors based on your asset size. And it's for them, I think, what the institutions need to do, and even those who help provide pricing analytics or other opportunities, is they need to really kind of start rethinking what that competitor pool starts looking like for organizations, because that landscape's changing drastically.
Excellent. I think it's a fabulous point and a great place to leave it. Ben, again, thanks for making time and joining us. This was a very fun conversation. I appreciate it.
Thanks, Jeff.